Hi, hello. Hello, welcome. So, yesterday we announced to our VIP list, which you can join at affordanything.com/VIP list. We announced to our VIP list that we are launching, we are opening the doors for enrollment for your first rental property. We're only going to open the doors for enrollment once this entire year. So if any time in 2022 you want to join our premier course where we walk you step by step through how to invest in rental properties, this is your one and only shot. We open, hello to whoever just said hi. This is your one and only shot. We open our doors only once a year, and we're going to be doing that in June, and all of the information is at affordanything.com/VIP list. But today, the reason that I wanted to come live with you is because we got a bunch of questions. After we made the announcement, we got just a flood of emails with a ton of questions, and I'm going to go through and answer all of them right now. And by the way, I have not prepped my answers or looked at this in advance. We're just going to go, because that's how the real estate market is. Especially now, the real estate market is you got to go. So let's get started. And we are going to start with a question from Rashad. Rashad says, quote, "I'm interested in buying my first home, but should I wait until either the inflated house prices or higher mortgage rates go down?" Rashad, great question. I know a lot of people have that same question. So let's talk about both of those concepts. We'll talk about why home prices are high right now, and we're also going to talk about high mortgage rates. All right, so because they're two separate discussions. We'll start with home prices. Now, climb in your time machine, rewind back to 2007, 2008. Back at that time, home prices were high for a completely different reason. Home prices were high because credit was very easy to get. And remember, there's a distinction between easy and cheap. Credit at the time was really easy to get, and a lot of people were over borrowing. They had too much debt relative to their income. They had too many loans on too many homes, and they were speculating on home prices, and speculators were selling homes to other speculators. And so there was all of this speculation fueled by debt that inflated the market. And then on top of that, all of that debt then got packaged into securities, which then got sold in ways where the securities did not reflect the level of underlying risk. And that was what caused the housing bubble to crash. So the whole thing was built on speculation and debt, and it was a total house of cards, right? Why are home prices high today? Why have they gone up so much in the last 2 years? It's for a very different reason. After the Great Recession of 2008, 2009, so starting in 2010 as we were coming out of it, builders were really scared of building because, we had just had this terrible home price collapse in 2008, and a lot of people back in 2010 were very, very gun shy about the market, as is very understandable. And so builders didn't build as much. And what's happened is, over the past decade, the supply of homes has been compressing and compressing and compressing. So the supply of homes has not kept pace with the demand for homes, because every year we have new household formation, we have population growth through immigration, and that slowed during COVID, but it is still net positive, meaning we are still net population growing. We're doing so at a slower rate than we were pre-COVID, but we are still growing as a population in the US. And so we have new household formation due to immigration, due to, 18-year-olds or 21-year-olds or 25-year-olds moving out of their home and starting new households, due to people who were living in a smaller home who during the pandemic began working from home and want to size up. We have all of this new household formation that's happening, and that means that the demand for homes, and meanwhile the stock market is high, which means a lot of people have very healthy 401ks. They have good balances in their portfolios. There are a lot of, and it's bifurcated, right? I'm certainly not saying everyone's doing well, but knowledge workers, educated knowledge workers, many are doing, have been doing very well, particularly as the stock market has performed well. Great 401ks, great salaries. We've got a labor market crunch, so people are getting paid well. And as a result of high incomes, high portfolio balances, there is consumer confidence that drives demand for housing, right? So what happens in a situation where you have high housing demand but compressed supply, and the supply, by the way, has increasingly compressed as a result of upstream material shortages, right? There's a lumber shortage, there's a copper shortage, right? We have all of these upstream material shortages that are not going to be worked out in the supply chain market for many, many years. And we also have a labor shortage. So when you have both a labor and a material shortage, it drives the cost of building up. When the cost of building rises, builders build fewer homes. And when you already have a deficit of homes, and then that deficit gets amplified by the pandemic and by all of the labor market constrictions and material constrictions that the pandemic created, all right, now you have a situation where demand is outpacing supply. So anyway, Rashad, to the first piece of your question about inflated home prices, this is not inflated home prices. This is home prices that reflect the fundamentals of the underlying supply and demand. We have a podcast episode. I believe the name of it is, I think we released it in like fall of last year. And it's all about, I think the title is something to the effect of like, why are housing prices so high right now? And it basically takes what I've just said and goes into much greater depth about it. So if you want, what I just gave you is an introductory primer, but the takeaway is that there is no economic reason why home prices would go down in value, right? So like if you think about that logically, supply and demand, when demand exceeds supply, home prices rise, right? In order for the market, and the market can cool, certainly, and by cool that means that it continues to rise, but at a slower pace. So if the slope used to look like this, now the slope looks more like that, right? That's what market cooling looks like. But for it to be deflationary, right? For home prices to be deflationary, there would have to be an actual reason why home prices would drop to below their current levels. And the only way not the only way, but one of the major ways that would happen would be if there was such a glut of new supply that supply outpaced demand, which is what happened in 2007. We're nowhere close to that. Tim Datsis, so are you saying housing prices are here to stay? Yes, I am. Yes, I am. I'm saying how the current prices of homes are here to stay. Now, what we've seen, like what we saw in the pandemic, was there's two concepts here. There's what the price currently is, and then there's the rate of acceleration, right? What we saw in the pandemic was the rate of acceleration of the growth of home prices was like a very steep curve, you know? If home prices used to be like, again, the trajectory, the upward slope was like super, super high, which is a way of saying home prices were growing in value very rapidly. Certainly, that's going to cool, meaning they will continue to grow in value, but not at quite as high of a pace. How quickly will they grow in value? No one knows. Maybe they'll keep pace with inflation and nothing more. That's certainly a possibility. But there's no evidence. There's no fundamental economic evidence that would indicate that prices would become deflationary, meaning that they would drop below their current levels. And certainly if new economic data comes out that shows that there's a supply glut, you know, that would change the equation. But in order for a supply glut to happen, we would need more materials and we would need more labor. And right now, with supply chain disruptions being what they are, neither of those things are happening. And so to the second part of Rashad's question, he asks about higher mortgage rates going down. First of all, mortgage rates right now on a 30-year fixed is around 5%. That's not high. That's what it was like a few years ago. In 1983, prevailing mortgage rates were around 13%. That's what my parents paid when they bought the home that I grew up in. 13%. So historically, we are in an extremely low environment, a low mortgage rate environment. But people tend to have short memories, and so people tend to forget that. Like, what's most salient is what's most recent. This is actually cognitive bias. It's known as recency bias, where we tend to overweight what happened most recently and give decreased weight to historic data. And so, if you think back to even 5 or 6 years ago, mortgage rates were 5%. And what happened in the last 5 or 6 years? Home prices have, whew, right? So 5 years, imagine if you had bought a house 5 years ago at a 5% mortgage rate. Or imagine that mortgage rates continue to rise, and 6 months from now, mortgage rates are 6% or 7%, right? Home prices are still going to go up. Like, if 5 years ago you had sat on the sidelines and said, well, mortgage rates are 5%, I want to roll the dice and hope that they drop to 3%, so I'm just going to wait it out until mortgage rates drop to 3%. Well, guess what? 5 years ago, 2017, you would have rolled the dice, you would have waited it out, and from 2017 to 2020, sure, your mortgage rate would drop, but the price of the home would rise so much that, you still lost money by waiting. And that's the thing, fundamentally, both of these questions are questions that essentially say, should I time the market, right? And what do we know about timing the market? What do we know from the world of stock investing about timing the market? Timing the market is a bad idea. It's particularly for buy and hold investors, which is what I am and what I hope you are. Because what I teach is buy and hold investing, long-term buy and hold, not market timing. We're in it for the long term. We're in it to buy and hold and enjoy compounding returns. Oh yeah, Andy says, friends waiting to buy a home in 2017. I'm waiting for this housing market to cool off, right? Exactly. Back in 2017, people were like, I'm waiting for the market to cool. People, didn't happen. And I heard people say that about stocks too. I'm waiting for the market to cool. Never happened. And so that's the thing about market timing. If you sit out of the game, because you're waiting on the market to cool down, you end up missing compounding returns. You end up missing all of that growth. And you know what? Okay, imagine this, hypothetical thought exercise. Let's just say, hypothetically, that in the year 2028, we experience this massive crash, right? And in the year 2028, home prices plummet back to the year 2020 levels, right? If that were to happen, number one, you would still have missed out on all of the rents and all of the principal pay down that you could collect between now and 2028. And number two, if that were to happen in 2028, do you really believe that that's the moment that you would suddenly develop the courage to make that move? That's the moment where you'd be like, yeah, this is the moment I've spent the last 6 years waiting for. No, you wouldn't. You would say the sky is falling, home prices have reverted back to 2020 levels, and so now I really want to wait it out because I think they're going to drop further, right? That is market timing mentality. And that's the thing that we know from the world of stock investing. Market timing mentality is the thing that keeps you broke as an investor, right? Market timing mentality is the thing that keeps you out of the game for so long that, if the market does drop, it might drop. If the market in 2028 drops, who's to say it's not going to drop down to 2025 levels, which is still higher than where it is today? That's what happens when you have market timing mindset. So exactly, hip hurish. Never time the markets. There's always opportunities as long as you know where to look. So yes, so that's my answer to the question that we got from Rashad. All right, so Sammy, so we got another email from somebody named Sammy. Sammy says, quote, the wife and I cashed out on a refi to a primary residence that we've converted into a rental property, and we now have $40,000 in cash. Nice work, Sammy, that's awesome. But we're trying to find somewhere to invest it before inflation eats it all up. Good call. Our real estate agent suggests that we save until we reach around $70,000 in order to qualify for around a $300,000 home as a rental property. we're living just outside of Houston, not sure if that helps. Hoping there may be other people in similar circumstances I can learn from. Thanks in advance, love the podcast. All right, so Sammy, what I would say back to you is the number 300,000 sounds rather arbitrary, right? Like what we do in our course, Your First Rental Property, the very first thing that we do with our students is we have them write what we call your guiding statement. And it's basically your sort of an investor policy statement, except policy is like such a boring word. But it's essentially like your vision, your goals, your principles, your values as an investor. It's the what am I trying to achieve and why? Because if you don't fundamentally know where you're going, like, it's if you don't have that roadmap, then everything is arbitrary, right? So my question back to you is, all right, what are your goals as an investor? Is it a certain level of cash flow? So for example, do you want enough cash flow that one of the two of you could stay home from work or could go down to working part-time, right? And if so, how much would that be? Would you need $3,000 a month for one of the two of you, either you or your wife, to go part-time instead of full-time? Like, would that be sufficient? Would it be $4,000 a month? Would it be $2,000? What is that number? And do you want, and the reason that I ask this is like, there might be some people whose goal is to buy the maximum number of units or the maximum number of doors with as much leverage as they can reasonably take out, right? Because maybe person A is 30 years old and they want to retire at the age of 60, right? And so they don't want to retire for another 30 years, and their goal is to buy as many properties right now at the age of 30 as they can, all on 30-year fixed mortgages, and all with as much leverage as they can reasonably get, without being like a weirdo about it. So that way 30, because they don't care about cash flow over the span of the next 3 decades, they care about having maximum net worth and maximum cash flow at the age of 60, right? So person A is going to have a very different approach, which means that they're going to be buying very different properties than person B, who has the goal of, one spouse going down to part-time work as quickly as possible so that spouse can stay home with a kid, right? Or stay home part-time with a kid, right? If that's person B's goal and that's a more immediate goal, then what person B is going to optimize for is immediate cash flow, even if that means a lower net worth 30 years into the future or fewer doors 30 years into the future, right? So person A might be optimizing for something that's going to happen in the year 2052, right? And person B might be optimizing for something that ideally would happen in the year 2024 or 2025. And the choices that you make, person A and person B, are going to be incredibly different in terms of what property you buy, how much that property costs, how many doors that has. Like, when your real estate agent is talking about a $300,000 home, are they talking about one $300,000 single family home? Or are they talking about a $300,000 fourplex, right? That there are just so many considerations. Thank you, Jonathan. Casual chat on finances. I'm glad you're enjoying it. There are so many different considerations around that inform what type of property, the number of units, the age and condition of the property, the amount of leverage that you use. Like, all of those are going to be, those are like downstream decisions that flow first from the question, what are you trying to achieve? Actually, here's the framework that I like to use when I think about this. All right, so imagine a tree, right? So the roots of that tree, the root structure is your values, right? It's like, these are your most core values. And the base of that tree then is your philosophy, and your philosophy on life, on money, on work, on life, that all stems from your values. And then as you move up the tree, that tree trunk is your goals, your objectives, the thing that you're trying to achieve, the life that you're trying to create, that's that tree trunk. And then stemming from that, like the limbs of the tree, that then becomes your strategy. Hi, Marcus. Oh, great to see a YFRP alumni here. Glad you're enjoying it. So your strategy, those are the limbs of the tree. And then from that strategy, then the branches that branch off of that, those are your tactics. And so what, Sammy, what this real estate agent is suggesting to you, buying a $300,000 home, that is one particular tactic. And that's the branch of the tree, right? Before you get to the branch, you need the limbs, and before the limbs, you need the tree trunk. Before the trunk, you need the base. Before the base, you need the roots, right? Hi, the Dividend Gypsy. No plans to visit Mexico yet, but that sounds amazing. Would love to. So Sammy, so that's my answer. Like doing the work doing the work at that root and tree trunk level first will, once you do that, you will know the answer to that question. So so that's my answer to you. All right, our next question comes from Silvio. Silvio says, a few months ago, I was ready to purchase a property overseas and the cash flow would have been great, but with the bad dollar exchange, it no longer looked like a great deal. So now I'm left with $50,000. Hey, Silvio, that's a great problem to have. I have $50,000 and don't know what to do with it. Love it. I'm left with $50,000, wanting to invest in a long-term property in or around the Orlando area. I can't afford single-family homes right now, and condos do not appreciate as well, so I'm left with either a townhome or a cheap single-family home. I don't know what to do. Please help. So Silvio, a couple of things come to mind right away. First, I'll refer back to what I said to the previous question, to Sammy's question. You mentioned that condos don't appreciate as well, which is true. Condos are the last to appreciate, typically, are the last to appreciate and the first to fall. And there's quick tangent while I nerd out on this for a little bit. I promise this will take like 1 minute. The reason for that, because I think this is super interesting, if you think about a property is composed of two pieces. There's the underlying land, and then there's the structure itself, right? So the underlying land plus the structure itself is the price of a property. When you own a condo, number one, you don't own the underlying land. Number two, you don't even own the exterior. You have a common usage to the exterior. But technically, when you own a condo, you own the airspace. You own the interior airspace and the interior walls, of that unit. And so, because if you own a single family home, you own the underlying land, and then you own all of the earth underneath, the rights to the earth underneath it, as well as the rights to the airspace above it, right? When you own a condo, you don't own the underlying land, you don't own any vertical rights, like you don't own rights to the airspace above your condo or to the ground below it. You own only the interior airspace inside of the condo itself. And that's the reason why condos tend to be the last to appreciate and the first to fall, because you own the least. But if your goal is cash flow and not appreciation, then condos can actually be a fantastic option, assuming that the condo has, thank you, Jonathan. Jonathan says, great explanation on condo ownership. And Jonathan is a real estate agent, great real estate person to know. So thank you so much. So if your goal is cash flow, and this is why knowing what your goals or what your objectives are is so important. If your goal is cash flow, assuming that that particular condo has a rent-friendly HOA policy, and that's the thing to really look for. But if your goal is cash flow, condos can be amazing for that, because you can get a condo at a much cheaper price than you could get for a single-family home of a comparable number of bedrooms or a comparable square footage, and it's not necessarily going to appreciate as much, but because the price point is lower, the cash flow on it, the price to rent ratio is way better. And so, Silvio, the question that I would ask back to you, and this goes back to my answer to Sammy, the previous person who asked, is your goal to maximize cash flow and residual income, or is your goal kind of that hybrid between cash flow and appreciation? If your goal really is appreciation, then you're correct. Condos are not the thing to buy if you're looking for appreciation. But I would invite you to at least critically ask yourself, what your objective is, just to make sure that you are not listening to the cacophony of voices that are out there that might make you think you want appreciation, when in fact, if you actually took a critical look at why you're interested in real estate, appreciation might not be your objective. But if it is, that's cool too. I'm not telling you what your goal is. I'm just inviting you to ask yourself, what is it that you're looking for in a property? So, assuming that you end up not buying a condo, you said you're left with either a townhome or a cheap single-family home. Correct. Both of those are great options. So basically, as I see it, you've got three options. Townhome in or around the Orlando area, cheap single-family home in or around the Orlando area, or investing outside of the Orlando area. Those are your three choices, and each of them come with various pros and cons. But if you decide that you're interested in investing outside of the Orlando area, of course that opens up a whole bunch of other markets. If that's not something that you want to do, I think both cheap single-family homes and townhomes are great options. So when you think of risk tolerance, right, investing out of state or investing non-locally is a certain type of risk. And so there's a certain type of risk that comes from investing in a location that isn't where you live. And there's a different type of risk that comes from owning a property that is in, let's say, a Class C neighborhood or a Class D neighborhood, like owning a property that is older or in fixer-upper condition or in a neighborhood that has a lot of tenant turnover or a lot of vacancies. Like, there are certain risks that come with that. And so the question is, which type of risk do you want to embrace? Would you rather embrace risks that are associated with, would you rather embrace neighborhood risk, or like age and condition of property related risk, or would you rather embrace the risk associated with investing non-locally? Both of those are risks, but they're two very different types of risks. And that, I think, is what makes real estate investing so interesting, is that when you're buying an index fund, you go to Vanguard and you see a little risk-reward spectrum, and it's like just a scale of 1 to 5 of risk and reward. But when you invest in real estate, you have different risk continuums. So there's one risk continuum that's the age and the condition of the property. There's one risk continuum that's the age of the property. There's a different risk continuum, condition of the property. There's a different risk continuum, amount of leverage on the property. There's a different risk continuum, location of the property in terms of city and state. And then a different one, location in terms of neighborhood inside of said city or state, right? Said city, And so as you slide the risk dial high on some of those, you want to counterbalance that by sliding the risk dial lower on a few other of those. That's how you create balanced risk. And so then the question is not how do you reduce risk overall across all of those. That's A, probably impossible in most markets, and B, not going to be a very profitable enterprise even if it is achievable. So the question is not how do you eliminate or minimize all risk. The question is, what brand of risk, which of those continuums of risk do you want? It's kind of like, there's an author named Mark Manson. He was a guest on the podcast, and he said something that really resonated with me. He said, what kind of pain are you willing to embrace? Like, what kind of, suffering are you willing to embrace? Because the analogy that he gave, he was like, a lot of people say that they want six-pack abs, but they don't want the pain of actually saying no to ice cream and doing a bunch of crunches every day and, tracking what they eat. Like, sure, everybody would love to like wake up and magically have six-pack abs, but a lot of people don't want the pain that it would take to get that. And so the question is not what are your dreams, the question is what pain are you willing to embrace? And if the pain of achieving six-pack abs is a pain that you're willing to embrace, then sweet, great, good for you. And if it's not, that's cool too. But that basically is that you take that principle and apply it to real estate. It's the same concept. It's which risk are you willing to embrace? And if you do embrace one stripe of it, then counterbalance it by minimizing risks on the other continuums. So that's my answer to you, Silvio. All right, we're moving to a question posed by Rick. And Rick says, everything is, quote, everything is so expensive where I live and interest rates are so high. It's hard to find a property that you do not have to pay a premium for, and most want to waive inspections, etc. So Rick, what I would say to you, let's go back to the beginning of this live stream. We're going to post a video of it to Instagram stories because my answer to the very first question is my response to what you just said. So when you watch the replay, like for the sake of the people who are on this live stream, I don't want to rehash it. But when you watch the replay, if you go back to my answer to that first question, that's my answer to that. Okay, but then Rick says, also, I am 60, so does real estate investing apply to me? That's a great question. Should you do this at 60? And he also says, ideally, I would want to find multifamily where I could house hack and live in one unit while the others pay for the whole thing. Yes, I love that. And yes, is that possible? Absolutely. 100%. I know plenty of people who are doing that, who are actively doing that right now. In fact, I mean, yeah, like, so I was about to name some names, but I'll keep their names private for the sake of their privacy. But yes, plenty of people do that. But of course, this is the numbers are very much going to depend on what market you're in. So Rick, I don't know where you live, but of course, certain markets, every market has its own unique, like, price to rent ratios. And some markets have better price to rent ratios than others. And when I say markets, I mean that in two senses of the word. I mean, broadly speaking, the city, the major metropolitan area, but also inside of that city, the specific neighborhood. And so there are some cities, the most expensive cities in the United States, like in Manhattan, the numbers are never going to work, obviously. But there are other cities, like we'll take Atlanta, for example, where in certain neighborhoods, those numbers wouldn't work, but in other neighborhoods, they would. So oftentimes oftentimes in those markets, people conflate their immediate surroundings with that broader metropolitan area as a whole. So we'll take Atlanta as an example. People will look at like some of the more expensive neighborhoods. They'll look at Sandy Springs or Dunwoody or Chamblee, and they'll be like, nothing works. And I'm like, well, duh. Like, you're looking at these like really cushy neighborhoods. Of course nothing works there, but let's take a look south of the airport. There's a ton there. Look at Hapeville. Look at Panthersville, right? Look at Ellenwood. There's a ton that works there. So, in terms of house hacking, right? But, and then it often becomes a question of like, all right, if I'm buying in those areas, that's going to increase my commute time to work by an extra 30 minutes, each way. So do I want to make that? And then it just really becomes a question of what do you value more? Do you value having a shorter commute, or do you value the cost savings? Do you value all of the benefits that would come from house hacking? And there's no right or wrong answer to that. That then just becomes a values question, and it becomes a question of, in the trade-off between the length of your commute versus the benefits of house hacking, which of those two wins? Which trade-off are you willing to take? So But I think the more, and same with like the, ideally you'd like to find a multifamily to house hack. I don't know, again, I don't know where you live. Let's just assume you live in Manhattan for the sake of example. Do you want this enough that you would be willing to move? Would you be willing to move to upstate New York where you could do it rather than Manhattan itself, right? That's the other question. I think the interesting part of your question is that you're 60, and what that tells me is that as someone who's 60, most likely, I'm guessing you would want to be optimizing for cash flow rather than for long-term like capital appreciation, right? And so what that says to me is that a strategy in which you minimize your leverage and you buy properties that have great price to rent ratios, even if they're the type of property that might not appreciate as much, those would be the types of investments to target. And the reason that I make that distinction is that there are certain areas, let's take Cincinnati as an example. Historically, properties in Cincinnati don't appreciate that much, or historically they haven't. But they have amazing price to rent ratios. So for someone who's 60, I think Cincinnati is a great market. But if you are 30 and your goal is to buy properties with maximum appreciation potential, then Cincinnati is not a great market for that particular set of goals. So a lot of this goes back to, are you trying to optimize for appreciation? Are you trying to optimize for cash flow? Are you trying to optimize for immediate cash flow or for like cash flow down the road, maybe at the age of 70? Like basically which of these trade-offs are you willing to take, and how does that inform the ultimate property that you end up buying? That's a big piece of what we work with, when we work with our students in your first rental property, is really defining those goals, those objectives, like so that you know what type of property is the best fit for what you're trying to achieve. Because the world of properties as a whole is so large, it's so ambiguous, it's so amorphous that, it's not all properties are conducive for all goals. So defining those goals first, defining that objective first, like once you know what you're looking for, it becomes easier to find. It's okay. Imagine that you were getting a dog, right? If you were like, I want a dog. Okay, cool. There are a lot of dogs out there. First of all, do you want a puppy or do you want a senior dog? Or do you want like a dog maybe somewhere in the middle, right? Like, are you looking for a puppy? Are you looking for a senior? Or are you looking for like a dog between the ages of 1 to 10? And if so, if it's between the ages of 1 to 10, kind of where in that range? Like, are you looking for maybe a 1 or 2 year old dog? Are you looking for like a 5 or 6 year old dog, right? And then beyond that, are you looking for a large dog or a small dog? Are you looking for, like, there's so many variables that just saying I'd like a dog is so little information that it leads nowhere, and it just feels overwhelming, right? But the more you narrow down, like once you really narrow down what you're looking for, then when you find that dog, you'll know it right away. Like that dog becomes easier to spot because you have so clearly identified all of the characteristics, all of the attributes that you're looking for, right? But you start with first deciding what you want, and then once you know what you want, that thing actually becomes much easier to find. It's almost counterintuitive, like by limiting and then further limiting and then further limiting. A lot of people are resistant to doing that because they think that's too limiting, but it is within those tight boundaries, it's within that limitation that finding what you want becomes so much easier, because you have such a clear idea of like, I want a senior golden retriever mix from a shelter, yeah, and that's specifically what I'm looking for, right? So that's basically the same exercise that we walk our students through when it comes to identifying what type of property they want, because properties are the universe of them is equally as broad, and that's why I think this topic can feel so overwhelming at the beginning. So cool. Thank you, Rick. Stephen, we'll do one last question. Stephen asks, I am 30, and my main concern right now is that we just bought our first primary residence. Congratulations! Which I plan to turn into an investment property in 4 to 5 years when we move. I'm in the military. Thank you for your service. That being said, I want to invest in an investment property, but feel like that won't be possible for a few years since I just got our first primary residence. Thanks for all your helpful content. I guess, so Stephen, my question back to you is, what is it that would, I guess I need more information. What is it that would preclude you from feeling as though it's possible to invest in an investment property? Is it having an adequate down payment? Is it having, is it something related to loans? Is it something related to down payment? Like what are the obstacles that you feel would stand between you and purchasing that investment property? And of course, given that you're in the military, you're eligible for a VA loan, which, it opens up the world of lending and it opens up a lot of opportunities. But I guess the information that I would need from you is, what is it about purchasing your first primary residence that you feel would preclude you from buying a second property? Again, is it down payment? Is it lending? I think both of those are once we identify the specific obstacles, then we can address those. Okay, actually, we'll do one more question. So Stephen, I've got some questions back to you for that. All right. So, ooh, cool. All right. So final question. Kiki asks, quote, I'm curious to know when it's optimal to use your current personal home as a rental versus selling it and buying a new rental from scratch with the proceeds. I love this question. Okay, so Kiki continues her question. She says, quote, many of us who purchased homes pre-COVID have seen huge spikes in prices and have lots of home equity because of the market, like $100,000 plus in equity in the past 2 years alone. Is there a formula you use to gauge if renting your home is a good investment? I know about the 1% rule, cap rates, etc., but I've never heard it applied in the context of a home you already own. Would you take how much you owe on the mortgage and apply it to those rules? Or would you take how much you purchased the house for, etc.? I love this. Okay, so first of all, Kiki, this is a great question. Second of all, throw the 1% rule out the window. Just pick it up and gone, bye-bye, nice knowing ya. All right, so the reason for that is, and I'm saying this really not just for you, but for the sake of everyone who's watching this and everyone who's listening, the 1% rule, and this is like one of the big misunderstandings of the 1% rule. The 1% rule is meant as a filtering mechanism for, like, if you're taking this huge basket of listings and you're like, there are 1,000 listings, I don't know what to do, there are too many to sort through, and you just need a blunt tool to just filter down the listings that are available so that you can take a closer look at properties that are likely to have a good cap rate. That's what the 1% rule is used for. It is just a blunt first pass filtering mechanism when you're sorting through a massive basket of properties, right? It's only meant to be used for that. You cannot deposit the 1% rule in a bank. You cannot list the 1% rule on your balance sheet. So ultimately, once you already own a home, the 1% rule no longer applies, because now your goal is not to filter through a whole bunch of properties. Your goal is to assess whether or not this specific property is a good keep. And so the 1% rule should never be applied to a specific property. It's think of it like your kitchen strainer, like, you know, the strainer in your kitchen, like when you're making spaghetti and you want to like strain the water out. That's the 1% rule. It's a strainer. It's not meant for anything other than that. What I would do in your shoes is 3 things. Number one, sit down and get clear on what your goals as an investor are in terms of, do you want the maximum number of doors? Do you want to buy as many doors as possible so that 30 years in the future they'll all be paid off, even though in the immediate term they won't be as cash flowy? Like, is that what you want? Or do you want to optimize for cash flow now? Or, you know, like, so A, what are you looking for? B, what's your risk tolerance in terms of neighborhood, age of property, condition of property? You know, what, like, where I'm going with this is, let's say hypothetically that you were to sell your home and you were to take that money and you were to buy 2 fourplexes, right? So essentially 8 units. But the 2 fourplexes that you buy are in, you know, they were built in the 1930s. They have a lot of deferred maintenance. They're in kind of rougher condition. And, you know, they're in an area that has a lot of like a lot of vacancy and a lot of tenant turnover. But if you can manage it well, those 8 units would have the potential for a lot of value add, right? Because of the fact that they have so much deferred maintenance. And also, you know, if well managed, they would have like a beautiful gleaming cap rate, right? Is that the type of move that appeals to you or not? And I ask that because for everyone who's listening to this right now, there are some people who are like, yeah, that sounds awesome, bring it on. Like, there's some people who get excited about that challenge. And there are other people who are like, no. I am busy. I have a career. I have hobbies. I have, I may or may not have a family. Like, I've got other things in my life and I want to optimize for what is most residual, even if it's not going to bring in as much potential money as possible or have as much potential value add as possible. And so that's where I'm going with that first question, is like, what are you trying to optimize for? Are you trying to optimize for potential future value? Are you trying to optimize for passivity or residualness? You know, like or simplicity, we'll say. Like, what is the flavor of real estate that you would like to own? That's the first question that I would ask. How does your current home, like, what characteristics of your current home fit with that? You know, does your, like, for example, is it the case that your current home would be low maintenance because it's probably in good condition, I'm assuming? It's probably newer-ish, I'm assuming. I don't know your home. But if it's not newer, it's probably at least in good condition. It's probably in a neighborhood that I'm guessing doesn't have a ton of turnover. You know, your current home is likely to be the type of property where you don't really have to deal with it as much, but the price to rent ratio or the cap rate might not be quite as strong. So is that a trade-off that interests you? Or would you be willing to trade off some of that stability in order to have the potential for higher returns? And it's kind of like, again, it's kind of like if you go to Vanguard and you look at their index funds and there's that risk reward slider, right? If you imagine that your current home is like lower risk, lower reward, but selling that or refinancing it and using that money to buy a bunch of additional homes, like, that's maybe higher on the risk reward slider. Where on that slider do you want to be? So, yeah, that's where I would start with that question. The other thing, so the thing is, if you were to use the equity in your current home, there are two ways you can do that. You can either sell your home or you can refi it. And if you sold it, you would still need somewhere to live. So what would you be doing in that case? Would you be house hacking? And if so, then the question becomes really interesting, because if you're house hacking, then you have the potential to take out a loan as a primary resident, which is like great interest rate, low down payment, but it also limits the geography of where you would buy that home. Or would you not be house hacking? For example, would you yourself become a renter? Or would you become a homeowner of a cheaper home? How much money would that free up? And then if you aren't house hacking, does that mean that you would then be investing in a different location, like maybe a different city or state, right? So those are like a lot of the follow-up questions that come from this. Like, if you were to sell your home, there are a lot of follow-up decisions that need to be made. So, but the other option is to refi the equity that's in your home. Then you get to stay in your current home, and you still have cash to deploy. So that's a good option as well. And then if you refi, you technically become a cash buyer, which means you've got some negotiating power. So, all right. So those are my answers to some of the questions that we've received. Thank you so much to everybody who's watching this live stream. This has been a lot of fun. We will continue to do more live streams answering more questions in the coming months. And remember, if you are interested in learning more about our course, we're only offering this course once this year. So if at any point in 2022 you want to learn about how to invest in rental properties, we're only offering the course once. Oh, thank you so much, Red Roses Mod. Thank you. I'm glad that you enjoyed it. Ink Color. So Ink Color says, wait, what? So we have a course. It's called Your First Rental Property. It is a complete A through Z course on how to invest in rental properties. So if we only open our doors for enrollment, normally we open our doors twice a year. Normally we have a spring semester and a fall semester. This year, 2022, we're only opening our doors once, and it's going to be in June. It's going to be, summer. Thank you so much, Jonathan. Course is bomb. So we are only opening our doors once this entire year. We are opening it in the summer. We're having in June of 2022. All the information, if you go to affordanything.com/VIP list, again, affordanything.com/VIP list, that's where you can sign up to get all the information. And again, we only are opening our doors for enrollment one time this entire year. So if you want to learn how to invest in rental properties, this is your one shot this year to do so. And if you sign up at the VIP list, we will email you a whole bunch of information about rental properties. So you will, whether or not you enroll in the course, like we'll send you loads of information about the market conditions this year, about inflation, about the risk of recession, about like how to navigate the 2022 market, as well as how to think about properties, rental properties, and real estate investing in general. So thank you so much for being part of this. I'm really glad that you joined, and I will see you in the next live stream. Thank you so much. Bye. Thank you. Bye.